Michele is a CPA, CMA, and founder of BookSmarts, an accounting software training and consulting firm based in Barrie and serving Ontario businesses both in person and virtually. She specializes in implementing sensible but scalable accounting and bookkeeping solutions, which help her clients to view and manage their business results and keep on top of their filing obligations. So again, welcome, Michele. Thank you very much. Folks, as I say, I've worked with Michele on several occasions and heard her speak, and I know you're in for a fun morning and a morning of a lot of information, a lot of valuable information for you and your business. I'd also like to welcome, I know we have some representatives from the Mom Market, Simcoe County with us today, sort of a collective of mompreneurs who are keen to learn how to improve their businesses and their cash flow management and expense management, etc. So welcome, guys, from the Mom Market, Simcoe County. We will be recording this session, and I will share it with you later on. It's likely to be a very large recording, so we might well just share it by our Dropbox link. But either way, we will get this to you, and you should all by now have the worksheets that were emailed to you yesterday evening, and you've had an opportunity to print them off, and we're all ready to go. As for questions, guys, I'll be monitoring the chat, so please feel free to pop your questions in the chat box, and we won't hold questions to the end. We will take little breaks throughout as we go through each section to answer questions so that they're sort of timely and relevant and everybody can follow on. Just seen an email there. Yes, someone's asking for the worksheets. Yeah, in a second, I'll forward those right over to you, James. Not a problem at all. So with that, guys, I'm going to hand you right over to Michele Craig, and enjoy, and we'll look forward to your questions. Thanks so much.
Thanks very much, Dave. Good morning, everyone. I hope you're all ready to find out all about expense tracking and cash flow forecasting. We do have quite a busy morning planned, so I'm just going to jump right forward with sharing my screen. I think we've got that one going. Okay, and oops, why isn't that going? Here we go. And here is our agenda. You should be seeing, Dave, am I displaying the agenda? Just want to make sure I've got it off on the right track here.
Yes, you are. Absolutely.
Perfect. Okay, so we're going to start by talking about how to track expenses. And one of the most common questions around that are, what are the expense categories? Like, are there different rules? Are there certain things that I need to be tracking? And actually, yes, I do have some good suggestions for you on that. So we're going to talk about tracking expenses. We're going to spend some time then talking about cost behavior and how to create and maintain a cash flow plan. It might be a little bit intense. I've sent you an Excel sheet. Please don't be afraid when you see it, because actually we're just going to work through everything line by line, and you'll see that it should all come together for you. I think a lot of the stuff is really intuitive, but maybe we'll be putting some names to concepts and just introducing you to a few things that'll help you in your cash flow planning. If we have time, we can get into how to source software and apps to help you manage your business. There's a lot of apps out there that are available as plugins to accounting software titles that can be very useful to you. But with a lot of choices comes a lot of questions, and perhaps you have some. So hopefully we'll have some time to get to that, and of course we'll do a final Q&A as well as Q&A after the first two sections. As Dave said, we want to kind of keep the questions in the areas of the webinar that they apply to, so that it's still making sense to you and to everyone. All right, so without further ado, we're going to jump right into accounts and categories. So just to back up a bit, I just want to tell you what I mean by categories. So when you record transactions in your books, you need to record them to certain lines or categories, or if you want to think of them as buckets, right? So you've got a bank bucket, and you take money out of there and you throw it into telephone expense or HST expense. You have to always say, when money is going in and out, what is it for? Was it revenue that I took in? Was it a grant that I received? Did I spend it on office supplies. So you need these categories. And your accounting software might refer to these as accounts or categories. I work in QuickBooks Online a lot, and when I'm looking at the reports menu or my chart of accounts, these are referred to as accounts. But when I'm in a transaction screen, it always asks me, what category do you want to use for this expense or revenue or whatever? So it does kind of use those terms interchangeably, and they do mean the same thing. So categories are the same as accounts. They are on your chart of accounts, and they are used in recording transactions in your books, and then they're arranged in certain arrangements to build your financial statements. So for example, recording a payment for your telephone bill will require the use of a bank account because you have to take money from somewhere to pay your telephone bill, so you'll need a bank account to track that money. You'll need a telephone expense account to receive that expense. And if you're an HST registrant, you'll also need an HST payable account because part of that telephone bill will be HST that you paid that you want to track separately so that you can reclaim it. So right there, paying your telephone bill, you've just affected 3 accounts on your chart of accounts. As I said, these accounts are then arranged to form your financial statements. So revenue accounts, expense type accounts, cost of goods sold, which is a kind of expense, you'll find all of those on your profit and loss statement, or sometimes that's called an income statement. Every other type of account is on the balance sheet. So what I want to do now is just take you through the, go to the T2125 report that I sent you, and I'm just going to stop this share here, a new share. And here's my T2125. You might have received this already in your handouts. And so this is the statement of business or professional activities, and it is a form that needs to be filled in when you, and am I sharing this, Dave? Just confirm that I'm sharing the T2125.
Yep, we can see
okay,
that. Yeah.
Sorry. Okay, thank you.
No, that's fine.
So yes, this form has to be completed for sole proprietors and partnerships and filed along with your personal tax return, because your business activities, if you're not incorporated, of course, go on your personal tax return. So the government gives us this form, and there are some very specific categories that are asked for on the form. So if I just scroll down to page 2, you can see that on the income, you really just have one category required for sales. So that's all the government needs to see. What were your total sales? And then keep scrolling down on page 4. I believe that's page 4, page 3. Page 3. Here are all the categories it wants to see for your business expenses. So we can see advertising, meals and entertainment, bad debts, that sort of thing. So those are all lines that you need to complete, and therefore things that you will need to be tracking in your accounts. Now, don't be afraid to break these down if these are too broad of categories for you, because as a manager, business owner, maybe it's more important to you to know the different types of advertising that you engage in. Are you doing print ads? Are you doing radio ads? Are you doing Facebook ads? Maybe you want to track those all in separate accounts too, so that you can get some more details, and you're absolutely free to do that. And then when you get to the end of the year and somebody needs to fill in this form, you can just add the 3 accounts that you used for advertising and put them onto the one line for the CRA. So don't be afraid to kind of flesh this out if you need some more details or you want some more details. Some of them are quite broad. For example, office expenses. That could be your telephone, your internet, all kinds of things, right? Utilities, I'll just point out, that is utilities and rent if you have space, like a bricks and mortar space that you either own or lease for your business. This is not where home office costs go. Continuing to scroll down, here we come to your business use of home expenses. So typically I don't enter those into the books through the year. I just kind of track it separately on a spreadsheet, and I can plug those in at the year end, because I don't really know how much the total is going to be. I don't really want to record those every month. And then scrolling down some more, you can see if you have a vehicle that is owned by the business or that you're claiming vehicle expenses on, here is where you can do your vehicle expenses, owned by the business or owned by yourself as well. It could be your own vehicle too. So sole proprietorships are a little bit different than corporations in that regard. So you're going to see that you're going to need an account for fuel and oil. I usually put my oil changes separately, but I don't want to lump them into maintenance and repairs because that's a different line item, right? And that's pretty much it for the T2125. So basically, you know, look at what you're going to be required to give to the government at the end of the year, and don't be afraid to break it down for yourself. And on the subject of breaking down those categories, if you're using accounting software, many times accounting software will allow you to do account groupings on your financial statements. So I could create an account called vehicle expenses, and then make my fuel and oil, my repairs, my you know, whatever else was on there, licensing, insurance, make those sub-accounts of auto expenses. So whenever I have a sub-account grouping, then on my financial statement, it'll subtotal it for me. So it's a really good idea to use the CRA categories as your master accounts, your header accounts. And then if you want some details, make them sub-accounts of that. So that way you won't even have to pull out your calculator at the end of the year. All of your CRA categories will be subtotaled for you, and you can just pick up the numbers right from your income statement. For some more suggestions on how you might want to organize your chart of accounts, there is a blog post that I wrote. I wrote it some time ago, back in 2018, but it's still very relevant today. I was just reading through it the other day, and it's still, everything applies. So I would encourage you to look at that and maybe pick up some more tips. I gave you the link for the blog post on the slides. It's on your slide number 6. So I would encourage you to check that out as well. And I am just going to flip back to my PowerPoint here. And we're done with T2125 for now. Okay. So again, best practices, break it down, use sub-accounts if your software allows, and there's a blog post for you to check out. Here's one of the most common questions that I am asked when someone is setting up their chart of accounts or taking on a new expense. They say, well, do I need to do a separate account for this new expense, or can I just add it to another more general, can I just throw it in with my office expenses or something like that? And so the answer is, if it's a separate line on the T2125, as we've already talked about, you know, you're going to need to create a separate account so that you can track it separately and do your taxes easily at the end of the year. If this new expense is combined or would be combined on a line with something else on your T2125, then you have a choice. You can either include it with your more general category, or if it's something, especially if it's a new expense that you're taking on, you might want to start that separate expense account just so you can keep an eye on it. If you find later on that you've created too much detail and you just have way too many accounts and you're profit and loss statement is now 3 pages long and virtually unreadable because it's just a mess. You can combine those. You can merge them. Most accounting softwares will allow you to merge accounts, and I know that in the QuickBooks world, it's just a matter of making sure that the account is the same type and detail type. And then you can just go into the one account, change the name of the account to be exactly identical to the name of another account, and you'll be prompted to merge them. And then they'll go together just as if they had always been one single account. So you can kind of undo those extra accounts later on if you find that you've created too much detail. So that's what I had on accounts and categories. Do we have any questions coming in on the chat?
We don't yet, no, Michelle. But folks, if you do have any questions, again, feel free to pop them in the chat or the Q&A. I'll monitor that and we'll bring them up as we go along.
Okay.
Thanks.
Good. Well, we're rolling along here. So I'm going to move on to forecasting cash flow then, since we don't have any questions on that. And so forecasting cash flow, you're going to be using your accounts and categories as a guide, but we also need to add some details, some transactional details, special activities that you have planned. And before we get into any of that, we do need to talk about cost behavior. So in order to predict how your expenses will roll out, and particularly with changes in income. I'm trying not to turn this into too much of an accounting lesson, but we do need to get into the behavior thing. And when we talk about behavior, of course, how can I resist a little Austin Powers meme? Oh, behave. So we have 4 basic types of cost behavior. And we are going to go through them one by one, but here they all are. So we've got variable, fixed, mixed, and step. What does that mean? Well, let's get into it. And don't be too afraid. I think the concepts are pretty intuitive. I think when we go through this, you might even find that you knew this stuff intuitively, you just didn't know what the names were. So let's put some names to these concepts. Variable cost behavior. So when you have a variable cost, it changes in direct proportion to your sales. So think items for resale or commissions. I sell t-shirts for $10. The t-shirts cost me $4. Therefore, my t-shirt cost is a purely variable cost. It's always 40% of sales, and you can see our charts going up here. Sales are going up, costs are also going up, but they're always maintaining that 40% of sales level. So that's a variable cost. Fixed cost is the opposite. It doesn't matter what happens to your sales, your fixed costs stay the same. So if you think insurance, property taxes, rent is a fixed cost in the short term. So no, you can see our sales graph is going up here. Sales are going up, 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 but my fixed costs haven't changed because it hasn't affected my insurance. It hasn't affected my space. Now here's where we get into some tricky ones. Mixed costs have a fixed component and a variable component. So I gave you for an example of that utilities. So you'll need basic power to run your lights, run the computers in the office, and that's not affected by sales. As long as people are present, you're going to have that hydro expense. But if you're also running production equipment or doing some sort of process before you're sending your items out for sale, then you're probably running equipment and machinery, and that would be kind of more of a variable hydro cost. So that's going to be very much dependent on your sales and how many orders you need to process. So on this graph here, we're showing mixed cost, and I put $1,000 of fixed and then 40% of the variable, 40% variable cost. So my sales, as my sales go up, my variable costs remain at 40%, but I also have that fixed cost of $1,000 that's going straight. So it's not going up quite as steeply as the pure variable costs. And at the beginning of the graph, when sales are quite low, the cost is quite high. It becomes that $1,000 becomes less of a burden on sales as your sales number increases. If you wanted to figure out what your fixed component was, I mean, I suppose if you had no sales in a month, that would give you what your fixed hydro was. Now, step costs are kind of fixed in the short term, but then you hit some milestones where you have to take on more expense. So I gave you here office salaries as an example. So let's say I've got someone in the office and my sales are going up and up and up and up, and this person is getting busier and busier and busier and busier, but they're still able to handle it until they get to the breaking point, and it's like, now I have to hire somebody. So I've got my sales have been going up and up and up on my graph, the blue line, and you see the expense line stayed steady for a long time, and then it took a jump up, and now it goes forward again at the new level. So that's a step cost. Now, you might be tempted to say, well, aren't all fixed costs really step costs? I mean, if you go far enough out, because if you go far enough out, your property taxes will go up if your sales increase, because you're going to have to take more space, or your rent will go up. And these are things that are fixed costs in the short term. So you might wonder, well, aren't they all really step costs? And I would say, well, yeah, actually, they are. You got me. Fixed costs tend to be step costs in the long term if your sales are growing. I think I'm going to stop for questions right now on these cost behaviors before we go into the cash flow process. Did we have anything come in, Dave?
We do, yeah. We have a couple of questions. Actually,
Okay.
The first one relates back to the previous section around T2125.
Okay.
And it's just, does the T2125 apply for corporations as well?
No, for an incorporated company, you've got a little more flexibility. You pretty much got all the flexibility to design the chart of accounts how you want to see it. And as part of your tax return, your tax preparer will do a reconciliation between your business income and your taxable income, and that's provided as part of the return. I think that the T2125 always kind of gives you a good guide, but no, you are not held to it if you're an incorporated company.
Okay, great, thank you. And then the second question relates more to this section around, question is, how would I track products that are purchased as stock and then sold? So essentially what this business owner does is they purchase items and then they resell them to clients. So how would one track the costs for that?
We are going to get into that a little bit. We're going to talk about inventory replenishment when we talk about the process of forecasting cash flow. But you're correct in saying that, you know, it's not exactly going to be cash following the expense in this case, because you're really going to have a big cash outlay. So when you go to forecast your cash flow and you're looking at your sales, I guess you would need to predict at what points you would have to replenish your inventory. Your sales will still inform what that variable cost would be, so what your inventory purchase cost would be, but instead of putting it steadily along with the sales in your cash flow forecast, you'll have to throw it into lump sums. I think it'll probably become a little more clear when we start going through the cash flow process.
Sure, no problem. Okay. That's it for questions right now. Thanks.
That's
Michele.
it for questions right now. Okay, so let's move on to this. So my recommendation, use a spreadsheet, and I did give you a sample spreadsheet. Now on the Excel workbook that you received, there's actually 2 worksheets. One is just a blank template that we can fill in, and the other one is the completed template that we'll be working on this morning. So you'll have that completed work with you as well, so you can review it. So start with a spreadsheet, or use a spreadsheet and start with the sales forecast. You knew, where we found out in the cost behavior, that sales is actually a driver for a lot of costs, right? Your variable costs and your mixed costs, and even your step costs over time. So you have to really start there. And I don't have a lot of input or advice to give you on your sales forecast. That's really more of a marketing exercise than an accounting exercise. So when I, as an accountant, used to do cash flow for my employers back in the day when I did that type of work, I would be given a sales forecast, and it's like, here's what we think, here's what sales thinks they're going to do. What's the cash flow going to be? And then I would start from there. So you really need to start with your sales forecast and try to get that pinned down as close as you can. And then from the sales forecast, you can map your cash inflows. So your collections, right? Because we're talking cash, we're not talking about invoiced sales, we're talking about payments received. So if you're sending out invoices and then waiting for payments, the cash flow forecast, the relevant number there is, when does the payment come in? I also want you to make sure that you're only including in your cash forecasts the actual costs of doing business, like what expenses is your business adding for you. So for example, if you have a home-based office, part of your property taxes are going to be tax deductible to your business because your office is in your home. But if you didn't have your business, you'd still have to pay your property taxes. So the fact that it's a business write-off doesn't mean it belongs on your cash flow forecast necessarily. If it's not costing you extra money, it doesn't. And then, you're going to determine your cost behavior, and you're going to do that as best you can. Don't worry about perfection. I will show you a process for going back and reviewing later and figuring it out. And I would suggest that the first few times you do this, you might not get that close, but you're always going to learn something about your business. And the more you do this, the better you're going to get at it. So determine your cost behavior as best you can, and then try to map out your expense payments according to when they are paid, not according to when they're incurred. So for the person who is replenishing their inventory, you're going to have to figure out all of your cost of goods sold, but you're not going to put those in necessarily into the same weeks of the sales. You're only going to put that expense in when you actually purchase. Insurance is another example of that. So if you are paying $1,200 a year for insurance, well, that means insurance is costing your business $100 a month. But how are you paying for that? Are you paying the whole 12 at the beginning of the year? Are you paying it in 3 or 4 installments through the year? How are you paying for it? And I would also say for HST, for you HST registrants out there, I would pull that right out of the cash flow forecast. So take the physical HST that you owe and pull it out of your bank account, put it into a separate bank account. And that way, when you're working through cash flow forecast, you can just look at your business bank and disregard the effect of HST. It's not your money anyway. So I'm reluctant to account for it as, really cash coming in or cash going out. To me, it's just money that I'm holding for the government, and then I'm going to give it to them when it's due. Okay, so now I am going to open up that Excel spreadsheet and share it with you. And we can start on that. Now, I also provided a bunch of information that we're going to put in to our cash flow spreadsheet. And you should now be looking at my Excel sample cash flow spreadsheet.
Yes, we are.
Perfect. Okay. So let's just do a quick overview here. I've got my sales forecast, my sales budget at the very top on lines 3 and 4. And then I totaled that up, total sales. And then I put a thick solid line because that's not my cash inflow forecast. That's just my sales forecast. Some of these sales have terms, and therefore I need to start my cash flow down here on line 7 and 8 with how are those sales going to be collected. And so that is really where the cash flow part of the schedule starts. So we're going to put in all of the money coming in on line 7 and 8. I've given you opportunities to add rows in each section. So if you have different lines that you want to add, just go here and click and add your row, insert your rows right there. I'm just going to do that. The reason I gave you these is because I don't want you to add rows at the very top or at the very bottom, because if you do that, it might not get picked up in these formulas that are on these lines. But if you stick your rows in the middle, your formulas will automatically expand to include those. So if you need anything more, put it in there. We've got our total cash inflows, and then we go into variable payments. So what are the things that are tied to sales? And some of these things will be done by formula based on our sales, because variable costs can usually be calculated as a percentage of sales. So we can just use a formula there. That way, when we plug in our sales numbers, the variable costs will populate themselves. After variable costs, there's a line for contribution. Contribution means is my total cash coming in less my variable costs going out. It gives me my contribution, my money that I have left over to contribute to funding fixed costs. So that's why they call it contributions. It's cash inflow less your variable costs. And here's all of our fixed cost payments here. And then once we've applied our fixed cost payments, we've got our total change in cash. Change in cash is your inflow, less your variable, less your fixed. That's your change. Down here, we put what was my opening cash, before this week, plus the change in cash will calculate your closing cash. And we're trying to get that closing cash as close to the bank total as possible. So that was your overview. Now let's start fleshing it out with some numbers. So my opening cash, first line on this detail, is $10,593. You can work along with this if you want, if it's not too tricky for you to keep up with the Excel and pay attention to the PowerPoint or to the presentation as well. So sales, for my sales, I'm saying that on account sales are stable at $2,500 a week, and clients have 30 days to pay. Okay, so $2,500. And I'm just going to copy that across to all of the weeks. A special order of $2,250 is expected the week of June 14th. So I know about that. So I'm going to plug that into my cash flow. So those are my on-account sales. Now my cash sales, for the week of May 31st, I'm saying it's $750. Now, and I'm finding that my sales have been growing just organically by about 1% a week. So on my next line, my next column, I'm just going to go, this equals this number times 1.01. So on the week of June 7, I can expect about $758 in organic sales. So in order to boost that a little bit, I've decided to do a radio ad campaign. And the radio ad campaign is beginning the following week, and I'm expecting a boost of 10% per week based on that. And by the way, I don't own a radio station and I've never run a radio ad campaign. Can you really expect a 10% per week and then level off to a new growth rate of 3% per week after the ad campaign? I don't know. That would be a question for the radio guy. So please don't decide to run a radio ad campaign because you want your sales to go 10% a week because Michelle at BookSmarts told you that would happen. So this one, we're saying now we're going to see a growth of 1.1 for the 4 weeks that the campaign is running. And then I'm going to level off to 3% a week growth. So I'm just going to go here. This is going to be last week plus 0.03. And I'm going to carry that over to there because I'm expecting it's going to be 3%, going forward. I've also given you here an opportunity to add columns. So again, you can just, highlight that column and go insert if you wanted to add more weeks. And by the way, you don't have to do weeks. Now, when I've done cash flow forecasts in the past, they have tended to be based in weeks because typically when companies are needing to do this type of a schedule, things are pretty tight. So we've got all of our sales mapped out. Now we can use that information to figure out what our inflows, cash inflows are going to be. Let's start with the easy one, the cash sales. Cash sales are cash sales. So I mean, there's no invoicing and waiting for money. As soon as the product goes out, it's paid for on the spot. So my cash collection is going to equal my cash sales for that week. So I just said B8 equals B4, and I'm just going to copy that across because cash sales or cash collections will always match the cash sales. Now the on-account sales, though, was different because these guys had 30 days to pay. So these sales done the week of May 31st, I am going to collect on this week. Is that how I did? Mm-hmm. So when I'm predicting my cash inflow on the week of June 28th, I have to look at my on-account sales for 4 weeks back and then copy those across. Now we're just going to pretend, because we're looking at this kind of, we took a chunk of weeks out of the middle of a year, right? So I'm going to pretend that I had some 2500s from previous weeks to fill in here. So I'm just going to do that manually. In the real world, this would be picking up from the previous weeks. So there is my cash inflow forecast. And I didn't have any miscellaneous sources of income, but if you do, if you're expecting other monies, you can put them in there, or you can add rows as many as you need. And if you'd rather just take a run at the cash without the sales, you can try that, but it's going to, because I get that question sometimes, you can try that, but it's going to make your variable costs a little harder to predict. So moving on to the variable costs here, my material costs is 15% of sales. And in this case, just to make it a little bit easier for us today, no inventory is held. So purchases are made as needed. And I like to get my stock in a week before, so that, because we are applying a production process to it. So I want to have my stuff in there so that I can work on my, my production. So my materials cost on line 14 is going to equal 15% or 0.15 of the following week's sales. Not talking collections now, I'm talking sales, because sales goes with production. Materials cost is triggered by production. So 15% of the following week's sales. And I'm just going to go copy that across. And again, at the end here, I don't have the next week filled in. So I'm just going to plug a number in here. But in the real world, you wouldn't do that. You would just put in the next week, and then it'll pick up the number for you. So orders are fabricated on demand and shipped and invoiced on the same day. So production labor is directly tied to the sales for that week. And it's about 25% of the sales for that week. So therefore, that means that if orders are fabricated on demand and shipped the same day, then that means my production labor is following my sales number because I'm producing, shipping, billing. So production week is on my production week, I'm producing that week's sales. However, I'm paying my production workers in the following week. They submit their hours and then I pay them their hours. So if I go here to my production labor cost, let me just go to my completed sample here, just give myself a little cheat sheet. So again, for this week, okay, on June 7, I am paying 15%, sorry, 25% of last week's sales, so last week's production. And again, that would have been, picked up from the week before in the real world. So when we talk about labor too, there's really two payments associated with labor, isn't there? Because you're paying your net pay, and that's what my 25% of sales was the net pay. And then later on the 15th of the next month, you have to remit the deductions that you took off those paychecks, plus your employer costs. So the employer deductions and taxes go into that 15th of the month. So I've just given the numbers here that were estimated $750 for the May payroll. That'll be paid on June 15th. Therefore, that goes in the week of June 14th. And on July 15th, we have to pay our source deductions for the June payroll, which is $875. You can probably come up with a percentage based on these numbers, based on your labor numbers. I didn't go there because I didn't want to get too technical. And I think if your costs are fairly stable, you're probably going to have a pretty good idea of what they are anyways. And then finally, I have shipping, and shipping is running at about 3.5% of sales. And again, that's going to follow that week's sales, not that week's collection, because sales are shipped as they're produced. So I'm going to go here, 0.035 times my sales for that week that I've shipped out. Are we good on variable costs? They can be a little bit tricky. And you know what? These percentages, play around with them, take a run at them. And some of them, like materials, are going to be fairly easy to calculate. Maybe some other ones are not going to be as straightforward. But what I suggest you do to get good at this is just start doing it. Start doing the process and then backtrack. Make sure that you're going back and reviewing and seeing what actually happened, and then you'll get better at it. The more you look at it, the more you'll learn.
We do have a question, actually, Michelle, that's really quite timely here because it relates to variable costs. And so this gentleman is an arborist, so he doesn't have a product per se. Would he basically put his, I think you've answered this, so his labor expenses would come under production labor. There's really no material costs at this point.
Is the labor expense tied to the sales, or are people on salary? So I would say hourly employees are a variable cost if they're directly associated with billable services. But if somebody is on salary, that's probably a fixed cost, because if it's not reacting to changes in sales, then it wouldn't be variable.
Right. So they've just popped in here that it is tied to sales.
It is tied to sales.
Yes.
Yeah, I mean, if you can calculate it as a percentage of sales, then it's a variable cost.
Okay, great, thank you.
And there might be some standard outside of the sales, if there are responsibilities that this person has that are there no matter what, then you could have, it could be a mixed cost, right, where it's got a variable component and a fixed component.
Quite. Indeed, yeah. And one more question actually at this point, please. So how far forward would you suggest a cash flow chart should look?
That's really dependent on the business. I've done 8 weeks here, so about 2 months. If you're doing a weekly basis, I think 2 months is good. If your columns are not going to be weeks, but they're going to be more like months or half months, then you probably want to go a little further out. I mean, it kind of depends what your concerns are for cash flow and when you think you might run into trouble. I would definitely do details for 8 weeks, and then maybe your future columns, you could have some other columns that are like, you know, a month column, like the following month and maybe 2 or 3 more months.
Right. So you'd spread it, what you've done in your sort of immediate future, then you would spread out the intervals and just move that along and sort of tighten them up as you go along. I see.
Yes. And you know, this is a rolling schedule too. So you're always going to be adding weeks. So you're just going to keep going week by week by week by week. So eventually those ones that maybe you just decided to do like a lump sum month in the further future, those will eventually come down to weeks columns if that's important to you to track by week. I think usually, and the reason I went with the weekly thing is because when I've tracked cash flow in the past, you know, there's been issues that needed to be watched fairly closely. And so that's why I've usually found that a weekly basis works best.
Very good. Okay, thank you. That's it for questions for now. Thanks, Michele.
That's it for questions for now. Okay, we're doing really well on time, by the way. So, okay, we've got an office employee, and this office employee is paid bi-weekly. Net pay of $1,300. Just got to figure out the weeks here, and that goes on to these weeks. So we're going to go to $1,300, and again, this is the net pay. Because labor and taxes goes in the lump sum in the month, and those are stable at $650 because the salary is stable. Oops, $650. So that way, then you can see that this employer deductions and taxes is a mixed cost. So we've got a fixed component here, and we've got a variable component here, which is tied to your production labor. So there's an example of a mixed cost and how you would handle that on this cash flow. You could put the variable portion in with the variable and put the fixed portion in with the fixed. And step costs, of course, would go on your fixed portion, because they are really, and then if you hit a step, so then you're going to obviously change your fixed cost at some point along those weeks. Okay, and the office labor, I also said, is an employee who will be taking holidays in July. So you need to account for that. If someone's going to be away, you still have to pay this person vacation pay. So that $1,300 hasn't gone away. But now you need something else. So the plan is for the owner to step in, because that's what we do as owners, right? And but we'll need a paid temp for 25 hours a week. So we're going to, I'm just going to flip back, see where it was. It was in these 2 weeks, 25 hours a week for $10, so that's $250 a week. And we're just going to pay that person as casual labor because they're only making the $500 for the whole year. So my utility cost is holding pretty steady. I'm not finding very much variation for production. Maybe my production process isn't very hydro intensive or machine intensive. So I found in this business then that it wasn't really worth tracking it as a mixed cost. I'm just going to plug it in as an estimate of my total insurance or total utilities. And it's $575 a month I'm estimating, and I usually pay that on the 15th of the month. So you can see that these weeks are getting pretty loaded up with fixed costs. And these are the weeks that you might want to keep an eye on where you could get yourself into some trouble. Rent is $1,250 and it's paid on the 1st of the month. So June 1st will fall into this week of May 31st. And July 1st falls into this week. I do have insurance of $1,200 a year. I'm paying it in equal installments of $400 3 times a year on March 1st, July 1st, and November 1st. So here is the week that contains July 1st. I've got an insurance installment due that week. So I'm going to put it in. And then future, and when I advance my weeks and I get to November 1st, I'm going to put the other $400 in that November 1st. I have a business loan and payments happen on the 1st of the month. So that's another load on that week. And they are $350. Now your business loan, bear in mind, loan payments usually have 2 portions, right? They have the interest portion and the principal. So if you are looking at your profit and loss statement, you're only seeing the insurance expense. The other part of your insurance payment, or not your insurance payment, the other part of your loan payment, the principal, is on your balance sheet, and it's kind of buried in there. I mean, if you look at your loan account, the balance will have changed. So every time you pay principal, you reduce that loan balance a little bit. So where you're going to see that on your balance sheet is by comparing what your loan balance was at the beginning of a period to the loan balance at the end of a reporting period. So again, this is another instance where your cash flow is going to differ from your financial statements and differ particularly from your profit and loss, because paying down a loan is not an expense, it's paying down a loan, and yet it's a cash flow item. So you have to put the entire loan payment on your cash flow statement, even though your profit and loss will only show the interest expense. So watch out for that. If you're using your profit and loss to kind of guide you in setting out what your costs are, which I do suggest you do, watch out for things that don't hit the profit and loss, that hit your balance sheet instead, such as paying down a loan, collecting a debt, purchasing equipment, because equipment, when you purchase it, if it's large equipment worth more than $500 and it's not a consumable thing, of course that is an asset to your business, and you can't just expense it through your profit and loss. You have to set it up on your balance sheet as an asset and expense it with depreciation over time. So when you're looking at your cash flow, you're going to see the money hit, the expense hit when you buy the equipment. When you're looking at your profit and loss, you're not going to see any expense until you're depreciated, and it's just going to be a little bit of depreciation every year until the whole thing has been written off. So business loan, and we've already talked about equipment. So let's put in our equipment that we're expecting to buy the first week of July, $850. See that net change in cash from that week of July? We're already in the negative here. And the other things that I need to slot in, office supplies and expenses, about $150 a month, paid on the 25th. So I'm just kind of estimating. I put that on my credit card and then I pay it off. If you have other expenses that go on your business credit card, then on the cash flow, right, those are only going to hit when you actually pay your credit card. And I don't mind if you put just one line for miscellaneous credit card stuff, but it might be more informative for you if you actually break it down into kind of these things that have happened. Like if you notice on our column A here, it's not necessarily your expense categories or accounts like we talked about in the first part of this webinar. It's also details of, things that happened. Like, when I put in a temp for my employees' holidays, I'm going to add a line for that. So office supplies and expenses paid monthly on the credit card. On the 25th of the month, I pay that. So that would be the week of 21st. And July 25th will land on this week of July 19th. So we're going to slot that in. And then I've got my radio ads. My radio ads cost $900. It was 50% up front. I don't know if I put that in the 7th or the 14th. I put it in the 14th. 50% up front. And then 50% at the end. You're probably going to have a lot more lines on yours. I just wanted to do a few so that we can do samples of everything. For the person who is asking about inventory, I think I would still do it like this, and then maybe kind of lump them together afterwards, like use this to lay out what my costs are going to be, and then figure out when I'm going to replenish my inventory. And you could even kind of maybe put these on a separate line above, and then you can use that to calculate what your inventory would be. Let me just give you an example of that. So if I copy this, say I put it up here around where my sales are. And that didn't work because it works by formulas, but pay special values. There we go. That should work now. There we go. So let's say I've decided I'm going to replenish my inventory here, and that's going to be 2365. So I'm going to go 2365 and wipe out these guys. And that brings me to this point, and then maybe these are going to be done on 2194 down on this. So for the person who was managing inventory before, I hope you chime in if this isn't making sense to you. So what I did was essentially, I took that whole variable cost line that was calculated as a formula, because it's still a formula based on sales, but I just kind of pulled it out of the cash flow schedule, and instead I put into my cash flow schedule those lump sum inventory replenishments. If you scroll right down to the bottom here, this is our net change in cash. So that was the total cash inflows, less all the variables out and less all the fixed out. I started with that $10,593 that I just plugged into the schedule at the beginning, but would have flowed through from previous weeks, and when there's continuity. And that 726 acted on it, and now I've got 11,319. So you can see this 11,319 is our closing cash for the week ended, or week of May 31st. Week of June 7th, it's my opening cash. And then the 1,031 net change acts on it. Now we've got 12,350, and that becomes my opening balance for the following week. So they follow through. Now, the other thing that I want you to do, because now that we forecast, I mean, it all looks very good, but we have no idea if it's right, do we? So what I really want you to do now is, once those weeks have gone by, so as each week clicks by, go back and revisit that week. And I want you to start plugging in actuals into your cash flow. So go back and compare what actually happened to what you forecast. So for example, this extra $22.50 in sales, did that happen that week? Or when it actually came about, was it 2 weeks later, and was it $3,500, not an extra $22.50? Then make the change. Oops. Make the change. Take it out of there and put it in here. So this is a living document. Each time you're filling in actuals, you're learning, and then you're also informing things that might have changed in your predictions, things that are happening earlier than you thought, or maybe that you found out that they're going to happen later than you thought, or for a different amount. And I want you to go through and plug in, okay, so what was my actual materials cost? Well, maybe it was $4.95. Don't worry about overwriting these formulas now. It's the past week, right? So you can go in here and you can say, oh, I actually collected this much, and just fill in all of the actual numbers exactly how they were. I actually had to bring in a temp here, let's say, for $580. So whatever happened, try to land your cash, your closing cash, as close as possible to what your bank actually showed. It's not going to be perfect. Take a run at it. By comparing and replacing with the actuals, that's how you're going to get better at this. And now, bear in mind, this is only going to work if you're keeping your cash and your business cash completely separate in a separate bank account, separate credit card. So if you're mixing things with your personal, or if you're using your personal account, you're not really going to be able to arrive at either a beginning or an ending cash balance, because it's going to be all mixed up with other money, right? And as I said, pull out the HST. So let's say you get to the end of this, you've filled in your actuals. It's not lined up exactly to your bank. Your bank didn't land at $479. It was actually like $11,005. And you don't want to go looking for it. Well, you know what I would do? I would go to the next week, and I would just overwrite it and put myself back to good. So if I've caught, 2 of the 12 things that were missing or incorrect here, I've learned 2 things. And then the next time, I'm going to tighten it up a little more. And the next time, I'll tighten it up a little more. And eventually, I will get good at it. The other thing now, the accountant in me says, now I'm looking at this schedule, and it looks like numbers that flow through. Remember, our closing became our opening for the next week. It looks like that's still going on. And I might not notice that I actually changed this. So what I would probably do is highlight that somehow. I would make this maybe a color to show, hey, I overwrote that amount. And I might even go here and just gray out these columns. So I'm telling myself, okay, I still want to keep these numbers. I still want to look at the history of what happened, but I don't want to make this a giant accounting exercise. If I've gotten pretty close to my bank balance, I just want to plug it and go forward and do better next time.
We do have one or two questions, actually, Michelle, if now would be a good time. Great.
Yes,
thanks.
absolutely.
Okay, so in terms of credit card, if you're using your credit card for inventory, presumably that would come under just materials cost. That's where you would account for that, regardless of how, that's just your vehicle for paying for your inventory at that point.
Right, right. I would still, you know what, I would probably use a similar process to what I showed you for the inventory replenishments that happen on occasion. So I would start by mapping out what is my material cost based on my sales, because if I can calculate that as a percentage, I know how much in total I'm going to have to buy. So lay all of that out like we did in this line by going, 15% of the sales or whatever the percentage is, and then use those numbers to say, okay, that's going on my credit card. When am I paying my credit card off? And, add up, however many weeks or numbers were paid on your credit card in the lump sum, and put that into your variable cost. I still think you can put it in your variable cost line because it is a variable cost, but you can smooth it out like that. I think you need to start with the weekly thing where you're calculating your costs based on your sales, and then just grouping them into payments.
Okay. And then in terms of, someone's asking if you could repeat, how would you calculate the variable costs where the product is sold as is? There's no production. I'm buying a product and I'm reselling it. So how might you calculate
the cost of what you bought? Like my example earlier, I buy T-shirts for $4. I sell them for $10. My cost is $4.
Right.
Maybe some shipping, but I have no other cost, no other variable cost. Okay. If you're not applying a production process, it's probably not affecting your utilities or anything like that. Rent is a fixed cost. So yeah, that would really be your cost of goods sold. There would be your only variable cost.
Understood. Thanks. And then the last question for the time being, if you are receiving a loan, what type of income would you categorize that as?
If I'm receiving a loan? Yes,
from the bank, let's say.
I would probably add that down in the miscellaneous income, or maybe add a row, like go in here and go insert loan proceeds. And then I got my $10,000 here.
Right.
And then now that I've got a loan, I need to go down into the fixed cost area and start slotting in my loan payments. Because, yeah, if you take out that loan, you'll have some sort of a payment schedule. And like I said, if you are paying interest on the loan, some business loans don't have interest, but if you are paying interest in principal, the total payment is what goes onto your cash flow, because that's the total cash.
Quite. Okay, great. That's it for questions for now. Thanks, Michelle.
Okay, cool. I'm going to head back to my slideshow now. I'm going to share. And so we're back to our process. So we talked about this, going back, fill in the actual cash flow that occurred, get as close as you can. And if you need to reset the cash level, you've gone as far as you could, you can't figure out the rest, or it's just becoming too much of an exercise, rewrite, take that knowledge that you've learned, put it in the vault, and reset your opening cash. And again, like I said, gray out the previous weeks, just so it doesn't look like something that flows through. I mean, you can do whatever you want with this report because it's a report for you, right? And then you just reforecast the weeks to come. So if you were wrong, if you were dead wrong on this, like, who's gonna know? Nobody. So Squirrely says, you're probably not gonna nail this on the first try. and that's okay. Take a run at it, compare with actuals. Don't worry about overriding formulas for past dates. And if you catch 12 things that you missed or got wrong when you first laid out your cash flow, congratulations. You just learned 2 more things about your business. And next week, maybe you'll learn 2 more. Any final questions? We're doing really good on time. Oh, my screen sharing is paused. Sorry. I didn't realize I wasn't showing my spreadsheet there.
No, you had your spreadsheet up.
No, I was trying to show my PowerPoint.
Oh, I see. Yeah, there's no other questions at this point in time, no.
Okay, well, it's do you know what? Can we take like a quick little break, and then we're going to move on to the sourcing the apps and software and apps.
Certainly. Well, it's by my watch, it's just before 11:15.
Okay.
Did you want to say 11:20? Give everybody a 5-minute break?
5-minute break, yes.
Perfect.
That'd be great. Okay.
All right. Thanks, Michelle. We'll see everybody back in 5 minutes.
Okay. Okay, we'll give a 2-minute warning. We'll get going again.
Sure thing. I think hopefully everybody's had an opportunity to refresh their beverage and stretch the legs a little.
We might finish up a little early. I was anticipating a few more questions because it is a little bit of a technical discussion when you get into the cash flow and the Excel sheets and that. Mm-hmm. So we might finish up a little early. So the fact that we didn't get as many questions means either I explained it really well, or maybe we lost a few people along the way. So hopefully it was just that I explained it so well.
Well, I'll tell you, everybody's still with us based on the numbers. So I think it's because you explained it really, really well. So thank you. It's interesting because we, in another session where we talk about business planning, obviously we get into a cash flow statement, and I have about 3 to 4 minutes, with everything else to discuss during that session to talk about cash flow. So it's wonderful to have an opportunity to really delve into some detail with it like this. So thanks again, Michelle. Super appreciate you being here today.
Yeah, no problem. And I would encourage everyone to use the schedule that I laid out there for you if you find that useful, and just kind of take a run at it, like I said. Mm-hmm. Mm-hmm. Well, okay, I think we're at 11:20. Can we get going again then?
Yes, indeed. Yes, okay. Absolutely.
All right. So I want to talk a little bit about sourcing software and apps. And now here's a little bit closer to what I do on the BookSmarts side of things. I've got a lot of clients looking around and trying to get more out of their accounting software by adding plugins or apps that work with it. And some of them work really well and some of them not as well. So I think it's important to know kind of what to look for and where some of the pitfalls might be. So first off, let's talk about cloud software versus installed software. So installed being your like a Sage 50, QuickBooks Desktop Pro, QuickBooks Premier, though that's an installed software, something that you have to load it on your computer and you don't need the internet to operate it. Cloud software being something that you have to log into online. Most apps are cloud-based. So they work very, very well with other cloud software. You can have some that work with installed software as well. It's not impossible. You probably need some sort of a web connector, which is yet another app, like an app in between that can connect the two. I know that in the QuickBooks world, there's one called Quickbooks Web Connector. And all of the apps that work with the installed version of QuickBooks use this web connector to bring online information into your computer. So watch out for that. If you're using installed software, you might not have the whole world of apps open to you. And when you go and find apps, I'm finding more and more what they're saying on their website is, for example, we integrate with QuickBooks. Okay, well, but there's two QuickBooks. There's the installed and there's the cloud. And usually if they just say QuickBooks, they mean QuickBooks Online. And they kind of specify when they mean the installed one, but it's a good question to ask. If it just says QuickBooks, I would ask the vendor, which QuickBooks? Watch out for Canadian apps versus US. This isn't as much of a problem as it used to be, but definitely anything touching payroll, and particularly if it's touching a installed software payroll. The US ones, they didn't tend to do it very well. And in fact, QuickBooks Desktop wouldn't accept input from a lot of those apps, even when they said that they did work with the payroll software. A lot of the US apps, they don't realize that they don't work with the Canadian version, because if it works in theirs, they go, well, what's the difference? Well, but it's different, because if anything's going to be different between two countries, it's payroll, right? Because all the laws are different. To a lesser extent, sales taxes. If it's US, they probably can manage sales taxes pretty flexibly, though, because I don't know if you've ever tried to navigate the climate of sales taxes in the US, but I mean, you have places that have federal taxes, state taxes, county taxes, and city sales taxes. I mean, there are literally software apps that you subscribe to that will keep up with all of the taxes and tell you what to charge and when you need to charge them. So be mindful of anything that has to touch taxes or payroll if it's not coming from Canada. Syncing and workflows. Now, this is the thing that I find is the hardest to get clarity from the app vendors. How exactly does it work? Because they'll tell you, you know, you can do your invoicing and it'll manage your inventory and do all of this stuff. Well, okay, but how does it do that? And what are the points where you need to put things in? Depending on how it's syncing with your software might drive how you do your data entry. So for example, if you've got an e-commerce website and it's helping you to manage your inventory. So you're using that app to create invoices. So it knows whenever inventory has gone out the door because it's making the invoices. How is the app going to know when you purchased inventory? Because it's going to need to know that too if it's tracking your inventory for you. Can it go into your accounting software and pull that information? Or do you have to put it in twice? Or do you have to record your purchases of inventory in the app? And then what? How do you pay your supplier bill? Like, how does the bill get into your accounting software? Does it send a bill over, or do you have to pay your suppliers out of that app now? So depending on how it's syncing and whether it's syncing one way or two ways, it might actually determine where you do your data entry and how you're doing your data entry. So maybe you can't use your accounting software to do your invoicing anymore because you're going to have to use your Shopify. So, and this, like I said, it's difficult to get the clarity on that, because when you're talking to the vendors, they're very much in sales mode and they only want to tell you that it does work and don't always want to disclose how it works, particularly if it's not a really solid two-way sync. Ideally, what you want to see in a perfect world is I can do my data entry either in my app or in my accounting software, and they talk to each other. Oh, here's a scary story. So I went to help this gentleman who is very technologically savvy. He wanted to have, you know, lots of automation. So he got a scanning app. He had to purchase a special scanner to go with it. And all he had to do was scan his bills and they would all go into his QuickBooks and create bills. And then all he had to do was pay. It would do everything. It would separate the HST and code all of his, put it all to the right categories. Great stuff, right? So we go to get this thing going. We find out it can't read the suppliers from his QuickBooks. So when you put a supplier, add a new supplier into QuickBooks, you also had to add it in this app. And then you had to map them. You had to say supplier over here equals this supplier over here. to map them together. So it was a little bit labor intensive. I was really disappointed that, why can't you just read my supplier file? Because a lot of software can do that. But see, that's an instance where not having clarity on exactly how things are going to work. And then when we start scanning the stuff, we found it's not picking up the expense categories, because we also had to recreate the whole chart of accounts in the app by typing it manually, and because it wouldn't accept an Excel upload. And what else? It wasn't detecting, it couldn't do HST. Not that it wasn't detecting HST, it couldn't do HST. So for every bill that came into his QuickBooks, he had to open it up anyways and put the HST in. So I mean, it was arguably more work than just doing it from scratch. So that's a scary story for you. And that was a few years ago. I think apps have come a little bit further since then. Hopefully that one has, because that was really disappointing. And plus the hardware investment, and he had to sign up for a subscription for the app, and it was prepaid for a year. And I mean, it cost him a lot of money for something that really didn't work very well. You can also have syncing apps. So let's say your app doesn't sync to your accounting software, or it doesn't sync very well. So there are actually third-party softwares who can connect things. Zapier is a big one. Tray.io is another one that I've heard of. There's another one, Net.io, I think it was. Zapier I've used. I think it's great. I mean, I have a Zap set up for, because I have a customer relationship management software. Whenever I set up a new lead in my customer relationship management software, it also sets up a Google contact in my Gmail, so that now I can email them from my Gmail, because I don't like emailing from my CRM. So, I mean, and that's a Zapier thing. And I also have a Zap going to zapping an invoice over as well. So there are softwares, and these ones, they tend to work with cloud to cloud. So you need a cloud software to cloud app. And then you can use Zapier or Tray.io to help build. And there's a lot of canned ones, especially in the Zapier, that you can share. So you can share one that you've created. If you've created a Zap, they call them Zaps. If you've created a Zap that works really well, you can share it to the Zapier world, and other people can pick it up. So that's where I got the Zapier or the CRM to Gmail one. I didn't even have to write the Zap. I just looked for a Zap that worked between Method CRM and Gmail, and there was one already. Someone had already built one. So that's another option for you if the syncing isn't maybe as robust as you would have liked. And then also seek user reviews, and not just on the software's website. You probably wouldn't post a good review or a bad review of yourself on your website, and neither do software developers. So I like to cold Google user reviews when I'm looking at a software or a particular app, and I see what the users have to say. And particularly when it comes to syncing, I ask questions like, what's the support like? Or I look for comments on what the support is like. Watch out for apps that are serving you from somewhere on the West Coast. Make sure that they've got long enough support hours that you're going to be fully supported through your workday. Do we have any questions on apps?
Yes, we do. Actually, we have a couple of things, Michelle. So from John, is there any risk of updates to online applications changing the way in which you work with me? Do you have any experience of, I downloaded the update and now I can't access my my figures or my records?
Well, the apps that I work with tend to be the ones that work with QuickBooks, and they do keep those fairly stable. I think that there's good communication between the app developers and QuickBooks. But yes, certainly that's happened. I've seen it more happen where something goes on in your computer, like Windows 10 knocked out a lot of stuff. But yeah, I mean, certainly it can happen. And particularly if you're using a third-party syncing. So if you've got a Zapier or something in between there, and it's not like so it's not a direct connection. I think that would probably be the most danger. I think that app providers who, their business is built on being able to work with accounting software, if they make changes, they're going to make sure that they're still working with the accounting software properly. And the accounting software, like I said, I'm in the QuickBooks world, and they are very, they're very into apps. Like they're not developing the QuickBooks Online software, in my mind, to the extent that they did the desktop software, where they try to do everything in the software. They're just basically sticking to the accounting, and they're onboarding like features slowly. But in the meanwhile, they're relying on these software providers to do all of the things that their accounting software can't do yet. So it's a very symbiotic relationship. So I don't see it happening a lot, and where you do see it happening would probably be more of a lesser known app and someone who perhaps hasn't paid for a developer kit from the QuickBooks, because I know that they can, there's subscriptions that they can do and they can sign up, but not everyone makes that investment.
Interesting. And then one more question, just around, again, this is to do with syncing. So you may have responded to this when you're talking about things like Zapier, but when you're syncing, how does it work if someone has purchased tickets for an event, per se? Do you have any experience of that, dealing with clients that do event sales tickets?
Event sales tickets? I've done Eventbrite myself. I haven't tried connecting it to my QuickBooks. I don't know if it does, in fact.
Okay.
But I would probably check Zapier.
Right.
And see if it doesn't connect directly, see if you can use a third-party app.
Right. Yep. That makes sense.
The thing is with the events is they can be really tricky to get into your books, is what I've found. You have to run a report because you'll get just the net amount. So if you want to track in your event, what were my ticket sales, and then track as expenses, what were all of my my Eventbrite fees and things like that, I think that might be challenging to do directly from the app, because it's really just bringing one number over, which is the net amount. It'd be worth looking into, specific apps. I find that when I've worked with customers with apps, it's rare to work with the same one twice. There's just so many out there, and people tend to find things, and it's like, hey, have you ever done it? And I'm like, nope, never heard of it, but I'm sure we can figure it out.
We'll give it a shot. Yeah.
Yeah.
Yeah, for sure. That's it for questions right now, actually.
Okay. Well, I mean, that was our final Q&A. So if anyone else wants to bend my ear about something else, not tax questions, though, please, I am available for you. Any other questions?
Any questions out there, folks?
Or anything from previous that you would like me to revisit? We'll give them a couple minutes for people to type, or
yeah,
I don't know if they have the opportunity to unmute themselves at all.
Let me see if we can do that. We can unmute. Actually, yes, we can open up people's mics here.
Yeah, so that might be.
So yeah, folks, you can.
Right. So if you don't want to type in the chat, you can go ahead and unmute yourself and just ask the question.
Peter has his hand raised. Peter, do you have a question there?
I don't have a question. I just wanted to say thank you, especially in the first half of the course. That was extremely helpful, going over the Excel spreadsheet and the different categories, as well as that tax form. This was very informative and I appreciate it a lot.
Thank you very much, Peter.
Yes,
Thank
thank you. Appreciate that. We do have a question in the Q&A. Have you used Shogo? I think I'm pronouncing that right. S-H-O-G-O, Shogo, to integrate
Shogo.
a POS to payment processor? No?
I have not. So here are the questions. And I would suggest, actually, I think I gave you a blog post on your slides. There's a blog post that I wrote regarding apps. No, I didn't, but I can send you that blog post if you'd like. Or you can go to my, you know what I can do? I think I can drop it in the chat. I'll do that before I leave. Yeah, but like I said, there's so many apps out there that it's actually pretty rare to work with the same one twice unless it's a biggie like Shopify.
Okay. And yeah, if you could share that in the chat, that would be wonderful. Thanks, Michelle. And Patrick has his hand up. So go ahead, Patrick, and unmute yourself and ask your question.
Hi, Michelle. I just want to know, it's in conjunction with the syncing again, in regards to when you're online and you purchase tickets and that sort of thing, you also have to go through a third-party processing company, like a Stripe or something like that, when you're purchasing tickets. Is there a way to actually track that also?
Like your Stripe?
Yeah. So it's a processing. So I'm online. It's an e-commerce site. Your payments are going through one avenue to another, and the processing fee and everything else with that supplier or vendor or wherever goes through Stripe if you want to do that, or it goes directly through that particular e-commerce site.
Well, I would suggest that probably the accounting entry is the one that's coming from Stripe, because that's the money coming in, right? So that'll be your revenue less your fees. And you'd have Stripe fees and probably event fees as well from.
Right.
Were you the Shogo question?
Sorry?
Were you the Shogo question?
No.
No, okay. Yeah. Yeah, I mean, I think you need to determine where the accounting entry is. And to me, it would be where the money is, which is the Stripe. I have used for events, I've used Eventbrite, and they have an integrated payment. So they actually collect themselves and then they just send me the money by direct deposit.
Yeah, I've used Stripe, Eventbrite, and I've used others.
It's expensive though, right?
Yeah, well, it is expensive. There are cheaper solutions out there than Eventbrite, but it's still just trying to categorize that, because there is fees associated with all those transactions, and I want to be able to capture those fees and at least reclaim them. Or at least pass them on, because there's some that you'll integrate fees back to the end user, or you'll absorb those fees, and then you have to be able to track that. So,
right, and you're going to have credit card merchant fees, and you're going to have your event fees,
right,
from your event place.
Yeah.
So, I mean, I don't know if there's a place where you could get a report. In order for you to be able to zap that over or automate your data entry completely with the fees and everything, there needs to be some sort of a report available. And I don't know if either of your apps is going to have that, because your event app isn't going to know about your Stripe fees, and your Stripe isn't going to know about your event fees breakdown.
Yeah, well, what happens with Stripe is that you'll get a full documentation of the actual transaction in itself, which will then you can easily bring over to your accounting side. The report in itself is that detailed. It's very similar to what PayPal used to do before, but I mean, PayPal is way too expensive to be using for anybody's liking.
Yeah. What are you using for accounting software?
Wave.
Okay.
I
was going to say, if it's QuickBooks, you could do a journal entry and just import, because you always have the option of importing journal entries from Excel.
Yeah, I mean,
I don't believe Wave allows data import from Excel, though.
I do it now with Wave.
Yeah.
So it's an easy sort of entry point that I can do. So
Okay.
yeah, well, those are my questions. But again, thank you very much. The presentation was very good. You know, it was really, really good in regards to information, and it's a spreadsheet. Again, the Excel one was great. So thank you very much.
Perfect. Thank you very much.
You're welcome.
Great. Well, I think that's it for questions. I can't see any more, Michelle. We'll just give everybody another moment if they do have something. And I will just mention, folks, that our next event that we have on our calendar is on June 16th. It's part of our Learning Lab series. Many of you will be familiar that we do a monthly Learning Lab. And June 16th at 10 a.m., we have some representatives from the Government of Canada, but also from Sun Life Financial, who will be talking about benefits and how you can, as business owners, what are some of the publicly offered benefits through the Government of Canada, and some of the privately offered benefits through organizations such as Sun Life, Manulife, etc., that as business owners you can put into place in terms of, you know, defensive strategies and how to protect yourself in the event of, you know, sickness or injury or something else happening to yourself personally that will affect your business. So that's June 16th at 10 a.m. That'll be a 1-hour learning lab. And I'm just looking here. We're having lots of nice comments come in about today's session. So thank you again, Michelle. I really, really appreciate you joining us today and sharing your expertise with the Small Business Center and with our you know, with our audience today. It's great having you. Maybe we'll run this as a sort of an annual event, so people can get a refresher, or new folks can jump on. Everybody, Michelle has shared a link in the chat there. Actually, it's shared to all panelists. So Michelle, I wonder if I could ask you to reshare that, but to share it to all panelists and attendees.
I see. I didn't get the distinction there. All right.
Yeah, no problem. No worries. So everybody should have that now. And folks, we will, you do have the slides, etc., but we will be sharing out the recording just as soon as it's downloaded. It might take you know, a few hours, maybe even overnight, because it's quite a long session. But as soon as the recording is downloaded, we'll get that out to you as quickly as possible. And with that, thanks again, Michelle. I think it's just upon us to just sort of wish everybody a great day, and thanks for joining us. Hopefully everybody can get out and enjoy this beautiful weather that we're having.
Okay, thanks. Bye, guys.
Thanks, everyone. Take care. Bye-bye now.